GC was, me and him were talking a couple weeks ago. He was like, man, I was on this webinar with another group, and everybody was like talking about like Detroit, 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 Detroit. And there's a couple of things that GC understands about rental property investing, full stop. And then there's a couple of things that GC understands about rental property investing when it comes to how Detroit is being positioned in front of investors that I was like, shh, let's do this on the show, GC. So we're gonna break down how Detroit is being sold because it's coming up in all these different conversations and calls versus what we like to talk about here in Jacksonville. Welcome everybody to your weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me as always, the man that I have just been speaking about for the last 3 minutes and maybe shushing before he spoke. The man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
Fantastic to be with you too, buddy. You were away on a spring break.
I was.
It wasn't to a historic downtown. Like the deposition.
Well, you know what? I did my research, but on that downtown, I went to Chattanooga, and I had an awesome time. We had an awesome time, my family and I. If any of you have the chance to go out there, it was a different type of vacation because, as we know, I tend to go on vacations that happen to be around awesome downtowns that are growing and thriving. I wouldn't exactly put Chattanooga there. We were walking around on Friday and Saturday, and my family was like, Dad, how come there's nobody around here? And I was like, well, it's a little bit of a different downtown. But man, super cool. Had a great time and refreshed and ready to rock.
Good nature out there, right?
Loved it, man. We went hiking. Stuff. Yeah, man. We found this awesome spot that it's called Snooper's Rock, and we was on the way back to Nashville as we were flying out. And man, it's just like you can go and find so many ways to interact with nature, and that's what we're all about a lot on our vacation. So I had a blast.
Cool, very cool. Well, I'm glad to have you back, buddy. I'm glad to be in studio with you.
Glad to be back.
Happy to have everybody here.
This is great.
Everybody back in the families in the house. And speaking of the family in the house, we got some breaking news, GC. GC said something a couple weeks ago, and then in typical GC fashion, he went back, double-checked, and realized I got some updating to do here.
Yeah, I got some updating to do. And you know what? We all make mistakes. One of my favorite core values in my family is mistakes are just blessings in disguise as long as you learn from. I made a little bit of a mistake with the numbers that I shared with you guys, and I wanted to share it with you. We're going to be talking a lot about population growth today, especially when we're comparing Detroit to Jacksonville. I had said that Jacksonville was the #1 MSA for population growth. And we weren't. I made a little bit of an error there. We were #6 in the entire country for population growth. And this is actually the most updated. The stats that I had before it was a couple of years ago. So anyways, long story short, we are #6 for population growth in the entire country here in Jacksonville, and we are #1 in the state of Florida. And there you go.
#1 in the state of Florida, #6 overall in the whole country. Pretty good. Do you do you remember who were in those first 5? Were they bigger cities? Were they smaller cities?
This is only cities that have 1 million or more people. Okay. So Austin's up there.
Okay.
Yeah, Austin was up there. Orlando was pretty high up there, although we were #1. So Orlando I think was #7 or 8. Okay. Cities in Texas and Florida. It's kind of what you would expect.
The two big growing states, right? Yeah, that's awesome. Cool, man. Well, good on you, GC, for going back and double checking the data.
There we go.
GC, tell me a little bit about this call when you were, I know it wasn't a call specifically about Detroit. It was a call about your love for workforce housing, which we're going to talk about here.
Yeah.
But take me back to that conversation that we had where, you were telling me oh man, I actually came up with these things of Detroit, and I'm like, this is pinging for me. Take me back to that conversation.
Yeah, I'm involved in a lot of different conversations, whether that's with our sales team or whether that's with our team in general or with some of our affiliate partners, or sometimes I get to have conversations with clients, or I'm here and I hear from everybody. And so when I start to hear 2 or 3 or 4 things that kind of ping all at once, it usually becomes some type of a show topic or whatnot. And that's really what it was for this conversation of Detroit. it started with a call when I was on with one of our affiliate partners, and the affiliate partner sells properties in Detroit and a number of other cities and Jacksonville. And the question that I received from them, which I had never received before in terms of Jacksonville versus Detroit, is they were saying, you know what, Detroit's growing a ton. Jacksonville isn't growing.
Oh,
you know, and I was like, huh, let me make sure I heard that right. And they're like, yeah, Detroit has X percent of home price appreciation, whereas Jacksonville's largely been flat for the last year. Why do you call Jacksonville a growth market? And I was like, wait, let's rewind that. I mean, normally when we're talking about how to position Jacksonville versus another market, it's kind of a given for the last 20 years that I've been doing this, that people understand that Jacksonville is a growth market due to home price appreciation trends. And largely, people have not seen Detroit that way. So that was interesting for me. That happened like 3 or 4 weeks ago. And then we were doing our quarterly market update for the team, as I've also shared here. And one of the great questions that the team asked me is they said, Gregg, how should I position Detroit versus Jacksonville? Because some people are coming to our sales team and saying, hey, listen, Detroit's probably going to have like 6% home price appreciation per year. You guys were flat last year. How do I overcome that? And I was like, wow, this is becoming a thing.
yeah.
And so we're going to talk about why this is becoming a thing, maybe where people are a little bit misguided, and we'll use some data and some perspective to help. But it really just came from 2 or 3 or 4 different kind of areas and segments of the investing population that I get to have access to. And I think it's a real time right now to help people understand how to evaluate growth, how to evaluate population growth, home price appreciation, rent price appreciation, because ultimately, as we've talked about, this is the biggest component of your wealth creation through rental property investing. So we're going to dive into that today.
Yeah, so let's do that. I think there's some new names in the chat and stuff like that. So bringing everybody into kind of like the fold here, right? Like normally when I would hear people comparing Detroit, they're like cash flow. You can look at this brick house for $20.
Yeah.
Yeah. And people really, really like that cash flow piece. And I would say our community is pretty indoctrinated into the idea that rental properties have 5 profit centers. They have cash flow, they have home price appreciation, they have tax savings, they have debt pay down, they have inflation hedging, inflation profiting. And when you lay it out in a pie chart and you see kind of like, wow, where the returns come from, somewhere between 60 to 75% of the total return will come from home price appreciation. When you lay it on a pie chart, it looks like a Pac-Man, right? Like that home price appreciation piece looks like the body of the Pac-Man. And because of that, we know that you don't want to trip over pennies on the cash flow side you don't want to trip over dollars to pick up pennies, right?
That's right.
So
we can trip over the pennies if there's a lot of dollars on the other side.
Yeah,
we're happy to do those.
Through some pennies, bro. I'll run through some pennies, some dollar bills, y'all. So that is why we like to talk about growth, right? And growth, when historically, Jacksonville has been a cash flow market that is also a growth market, as we just talked about, 6th fastest growing MSA in the country, fastest growing in Florida, which is one of the fastest growing states in the country as well. So normally, like we're not in a heavyweight fight versus somebody else saying growth plus cash flow as well. So talk me through what people were getting wrong on or at least just talk me through, let's just talk about it. Talk me through what people were getting wrong on the growth side in this conversation that you were.
Classic example of having some data but lacking perspective. Because, if you look at data in a very short time period, you might find data that would show that Detroit has appreciated more than Jacksonville or appreciated more than some other cities in the country for a very short time period. But when you scale it out and you have that perspective to look much longer and over a full market cycle, you start to see different conclusions. And you would see different conclusions because there are different inputs. The factors that lead to home price appreciation are very different for a place like Detroit versus a Jacksonville or another growth market. So just a classic example of a very short window using some data to hopefully get to a conclusion that is probably better serving for whoever is looking at that versus the way to actually evaluate growth. For all of us, we're in this to buy and hold for a full market cycle. So if you are very myopic and you're only looking at 1 year, you can largely convince yourself of anything. And that's where the Detroit as a growth market conversation is coming from.
And here is the slide that you put together for us, GC. I'm seeing that 6.2% thing that your team was talking about, right? So like for those of you listening on the podcast, we're looking at a top US cash flow markets home price appreciation chart, right? We got Memphis, Cleveland, Indianapolis, Detroit, and the US. And it shows from 23 to 24, 2023 to 2024, Detroit showed a home price appreciation of 6.2%, while Jacksonville showed a home price appreciation of 0.1%. But then when you zoom out from the last 10 years, right, from 2015 to 2024, Detroit has a home price appreciation of 7.3%, while Jacksonville has a home price appreciation of 8.7%. And if you zoom out even further over, from when we first started getting really good data on this stuff, which started in 1982.
That's right.
To 2024, I learned that from you. Detroit has an overall home price appreciation of 3.9% to home price appreciation of 4.8%. What's important to like understand here, GC?
First of all, these are home price appreciation rates per year. So it's average annualized home price appreciation rates. So 23 to 24 was the latest data that we had available. And you can start to see why some of these historically slow or very low growth markets have actually had higher home price appreciation for that 1 year. You can start to see where turnkey providers and those who are selling properties in those areas might say, oh, you know what? Let's capitalize on this and let's call this a growth market.
Yeah.
So you can see Cleveland, you can see all of these, Memphis, Indianapolis, Detroit, all greater home price appreciation than Jacksonville for this 1 year. But the reason why that happened is because so much capital and so much building happened in Jacksonville and these other Sunbelt cities over the previous years, really over the previous 15 years, that we have normalized in Jacksonville, whereas everybody else is kind of still rising a little bit, or certainly was rising, and really just didn't have the same type of growth that we had for the previous 15 years. So you start to see that play out as you go to the next column there, right? Which is over a 10-year period of time. Now, a couple things to keep in mind, right? This past from 2015 to 2024 was great for home price appreciation for everybody, right? This was the age of easy money. This was the age of very low interest rates. So everybody's going to look like a winner. So again, if you wanted to position yourself as a growth market and you're in Detroit or in another one of these markets, you had one really good year of home price appreciation in the last 10 years, you might put the last 10 years of average home price appreciation on your evaluation. But that's just not real. Not really a good thing to do, because the person who's buying that asset at that point, if they use 6 or 7 or 8% home price appreciation and they project that out for the next 10 or 20 years, they're going to be mistaken. They're going to be left not achieving that, ridiculously high home price, the return on investment, because the home price appreciation is just not going to be this high.
Yeah, that makes sense. And one of the things that stands out to me when I look at this chart, I didn't read this for the podcast, but this is all compared on the bottom rung is the US average, right? So like you said, from 2015 to 2024, the US average was 7.3%, which is where Detroit ranks, right? So like to be considered a growth market, you should be above the US average, right? Which Jacksonville at 8.7% over the last 10 years does that. The rest of this chart isn't really, except for Indianapolis. And then if you look across since 1982 till now, this chart, like the only one here is Jacksonville. That's at 4.8 versus 4.6%, right?
Yeah, exactly. And what you fail to see if you just look at the numbers here is the magnitude of an additional 0.5% of appreciation every year, or a full point of appreciation every year for 40 years or for 30 years or for 20 years. For you as an individual investor, that adds up to hundreds of thousands of dollars of additional return on investment on one asset. 0.5% or a full percent of additional home price appreciation really matters. And so that's why if you span out beyond just 1 year and you go to the 10-year, now you start to see Jacksonville really becoming a growth market, higher than the US by a large margin, higher than the other cash flow markets by a large margin. And then you span out to 40 years, which really shows the growth trends the effect of population growth over those years.
Yep.
And that's where you really, really start to separate. And then that's where the biggest magnitude comes in as far as what ultimately hits your pocketbook.
Yeah, that makes a lot of sense. When I think about this kind of like comparison between a 1 year growth trend versus a 10-year growth trend, or a, you know, 30-year, or I guess it's 40-year growth trend, 42-year growth trend if we're looking back from 1982, I'm thinking about my different investing decisions, right? Like if I was a flipper, then I would be thinking about, okay, what is it right now? What is it in this like 1 year?
Mm-hmm.
And where are we in that like snapshot?
Mm-hmm.
And like how long am I going to hold this thing versus like how much things are bound to change? I think when I think about buy and hold rental property investing, the get rich slow style, I think of this idea that we talk about all the time. It gets better over time.
Mm-hmm.
We see the numbers get a lot better in 10 years. We see them getting like really awesome in like 20 years. And then like 30 years in, that's like this like unbelievable, thing that only continues to give you better and better results. So the idea of having at least a home price appreciation averaged out for as long as I plan to hold it, I think just makes a lot of sense for me, as opposed to thinking, oh, okay, man, if this thing did this thing 1 year ago, that's what's happening, and that's what's going to happen while I hold on to this thing for the next 15 or 20.
And I would say that typically plays well, but I would caution you if you're planning on holding for 10 years, don't just use the last 10 years of home price appreciation.
Mm-hmm.
Because it's highly unlikely that the last 10 years of average home price appreciation will be what you get for the next 10 years. Because it was an artificially inflated time with extremely low interest rates and easy access to money. So use the length of the data that you have at your disposal is the longer the better when you're making these types of decisions. The absolute minimum would be, call it 10 to 20 years of data, but be very, very cognizant not to just use the last 10 years because it's highly unlikely to repeat itself.
Nice. And Nate Stoll, who is the Detroit
From
guy.
Detroit.
Yeah, Detroit guy. Nate, anything that you bring up, we're going to talk about here, right? So Nate's asking, what's your prediction for Jacksonville growth for the next 10 years? Do you see 2023 as the low, or will it be less than 1% a year for the next decade, like that 12-month period? You see, I think this allows us to talk about what drives actual growth, right? Which is home price appreciation follows population growth everywhere, right?
Absolutely. Absolutely. Population growth is very different when it comes to Jacksonville versus Detroit and some of these other cities. So maybe we'll show that, and then I'll give you, an answer as we kind of, build up, the thesis here. Here's the population growth from over the last 40 years for these same cities, and it starts to you start to understand why you have a separation between a growth market like Jacksonville versus a market that historically does not grow as much, which would be Detroit. Comparing population growth from 1981 to 2024, Detroit's population today is 22% lower than it was in 1981. Whereas Jacksonville's is 134% higher. You can see the other cities as well. Some have grown, some have not grown. Cleveland's population is actually 4% lower. And so population growth drives home price appreciation. It drives rental demand, and especially over the long haul. So, the reasons that people move generally do not change. In fact, with the advances of technology and how we're not as tethered to our jobs today as we once were, you can make an argument that people are probably going to flock to some of these cities and areas where there's better weather and better taxation or no state income taxes, more business friendly. You can make an argument that people are, this trend is going to be exacerbated if you wanted to kind of go down that line. But either way, people move to places where the weather is great, where there's no state income taxes, where it's business friendly, and there's a low cost of living. And those things generally don't change over time. So Nate, to your question, what we would expect and what you would see on all of our property evaluations is the average annualized home price appreciation rate for Jacksonville over the next 10 years. And that number is 4.8% per year. That's data-based. That means we go back and we look from 1982 all the way till today, and then we take the average there. And that is a conservative, data-driven approach to home price appreciation. And that's what we would expect. And, it's hard. I just haven't seen that data-driven, long-term perspective approach used with many other turnkey providers out there. So Many don't have the access to the data. We spend a healthy amount of money on the consulting and the data that we have, so we have better data than most out there. But, it's to a provider's best interest for them to put a, 5%, 6%, 8%, 9% home price appreciation rate on their pro forma, because it juices your expected returns from 10% to 25%. And they, and that, especially for newer investors, seems really exciting. The problem is it just has never panned out that way for a 10 to 20 year hold.
Yeah.
And especially not in some of these cities like Detroit.
Yeah, and LinkedIn Lowry is saying in the chat, Detroit growth in a very small area of downtown, but vast majority of the area is not doing as prosperously unless you go to Grosse Pointe, which goes to David Blattner's question. Are these population growth numbers for MSAs or for city propers?
Great question. These are for MSAs. That's really the best way to go about making a decision on your rental properties. MSA is taking into account all the economic drivers and the population that lives in those economic driver areas. So it's a little bit of a bigger picture than just the city.
Yeah, Michael Santoro is saying property. And by the way, I would love for you to confirm that, Nate. Is that true? I was in downtown Detroit for a wedding a couple of years ago and I loved it.
Yeah.
Like I was like, why is everybody talking trash about Detroit?
Right.
And yes, I went to Grosse Pointe because that's where my best friend's sister lives. There's a doctor and it was a super nice neighborhood, right? So
Nice.
like I was in that bubble, felt really, really cool. But I've heard that as well, right? Like I never kind of like left that bubble. So I'd love to hear from Nate, kind of like how does it distribute across everything? Do you feel it growing, Nate? You who lives there. Patron Santorio says property taxes appear to be as high as 3.2% in Detroit versus Florida at 0.89%. If Florida does away with property tax, more people will move to Florida.
Yeah, that would absolutely happen. If Florida does go and eliminate property taxes or even reduces property taxes, you would see significant growth on top of the significant growth that we already have. Would be a good thing if you just are thinking from the lens of owning properties.
Yeah.
Because at that point, they would instantly become more affordable, and then you would see, more people flock here.
Gregg, as you're making that answer, and I was thinking about talking about downtown Detroit being really, really cool. I was kind of surprised that you didn't say anything about in the next 10 years, downtown Jacksonville when it comes to home price appreciation. You want to kind of like catch everybody up there since we're doing, I know that a lot of our community knows this, but if we're doing a holistic comparison versus a city whose downtown is already thriving and that's where it is, and now the other areas need to fill in versus a city whose downtown is where we're at.
Yeah, I think this is a once in a generation opportunity to hitch your wagon to the next great American downtown by investing in Jacksonville. And the data supports that as well. In Jacksonville right now, there's $6.5 billion of construction that's going on in downtown. We're in the midst of our revitalization, and $6.5 billion means a tremendous amount of employers and amenities and mixed use development and a brand new stadium of the future and a new museum of science and history and the University of Florida graduate campus. I mean, I could rattle off project after project after project. We've done a number of these calls, so if this is your first time here, would encourage you to go to YouTube and find some of our past shows specifically about it. But this downtown Jacksonville revitalization is big because we've also studied what happened at other successfully revitalized downtowns, thinking of places like Nashville or Austin or Denver or Tampa. What happens is home prices and rent prices and median incomes go up significantly for those rental properties that are owned surrounding those downtowns. Home prices actually went up 89% more for those successfully revitalized downtown cities compared to the national average, and that's from 2005 on. So the thesis is, listen, you've got a market here that is already a cash flow positive market here in Jacksonville, already has shown to be a growth market over the last 40 plus years and is growing more, right? Number 6 in the entire US for population growth. That's a really good sign. But then on top of that, this is a special time because of what happens when when downtowns get revitalized. A key metric that we look at is how many people are living downtown. Mm-hmm. Because for a revitalized downtown city, you measured a number of different ways. One of the ways is how many people live in downtown. That is a great sign that if you have growth of population downtown, living downtown, other good things are on the way. More money will be spent. Quality of life will go up because you have more restaurants and grocery stores. And so downtown Jacksonville has about 9,000 people living here right now. That's up from about 3,500 over, geez, I mean, it's doubled in the last 10 years for sure. And once you cross 10,000, that's when things start to really go fast. I just spent some time in Nashville as we were flying back from Chattanooga, and I remember driving as I was going to the airport early in the morning, and just seeing the downtown landscape. It is completely different, and we have pictures to show this. You can find them on past episodes. Completely different in a 10-year span. Yeah. Well, that really happened once downtown Nashville hit about 7,300 residents living downtown, and now they have 20,000. Yep. So the thesis for Jacksonville, and to answer Nate's question, do I expect home price appreciation to be 0.1% or flat for the next few years? No, I don't in Jacksonville. This is a moment in time. We're coming off of, many years where we had 8, 10, 12% home price appreciation per year. And so a natural normalization is necessary. It's good. It's good for the market here. Yep. Over the next 10 years, we would expect at a bare minimum to see what the average appreciation rate is, which is 4.8% per year or thereabouts. And then you're sprinkling on this special once in a generation type opportunity by hitching your wagon to investing around downtown Jacksonville. Those are the rental properties that we sell at JWB. And so I think you have significant upside there.
Did you talk about that on the webinar?
On the webinar for the Detroit conference? Well, it was more of a conversation that I was having with my affiliate partners, and they were sharing questions that their client base was saying, "Hey, we see Detroit being a growth market." So sometimes I just keep some things in the back pocket.
I didn't think you would have brought that up. I feel like you wouldn't have brought that up if I didn't pin you right now on that.
No. I mean, that's why we're such a great team. You bring it out of me.
Yeah. All right. So that being said. So cliff notes on what Gregg just said, right? When downtowns turn on, it's called going from an 8-hour downtown to an 18-hour downtown.
There you go.
All right, I usually mess that up when I say 16-hour downtown. That's why I pause. There you go. It goes from 8-hour downtown to a 16-hour downtown, right? Like you go from only going to 60. Only going to a downtown to work, and then going home to then going to a downtown to like work, live, play. It's an entertainment destination. It's there, right? Like you and I have recently really put downtown into our entertainment destination rotation by going to the opera. Well, not the opera, but like musicals and plays and concerts.
Dancing with the Stars, where I took my wife.
Dancing with the Stars.
That was awesome.
The park, like all that stuff that's happening in downtown, right? It becomes a destination. And once it really becomes a destination, then people flock to it. And once people flock to it, then you start getting this population growth. The population growth is happening. The moment that it hits this like number of like 10,000 residents downtown, which we are very on track to do that within the next 12 months, is what I understand. Then it makes developers' numbers work. And then they start to like really be able to like pencil in these like really cool value add projects that continues the flywheel and continues it happening. And we're right on the cusp of that happening. And now we know, because of the data nerd that I have here on my right, that when that happens, you go through this moment of elevated home price appreciation. That's coming to Jacksonville. We believe it's undeniable if you've seen it, right? So that being said, that is the appreciation play. Oh, Nate has a take. I like this. Nate says, I do expect Detroit to see growth over the next 5 years, but not sure about the next 10 years. Though cash flow appreciation is difficult in Detroit due to increasing property taxes, utilities, and even potential increase in state income taxes. Interesting, man. Interesting.
Yeah. And I would just add on to that, my message here is that it's not that I don't think that there will be growth in Detroit. It's just, should it be viewed as a growth market? I don't think it should be viewed as a growth market. A growth market would be, do you see growth above the U.S. average growth? Yeah. So, investing in real estate is a really good idea because it's a hard asset and it tends to go up. It tends to grow with the rate of inflation at a bare minimum. Yeah. And that's what you're sort of seeing in Detroit over the last 40 years, right? It's gone up, 3.5% or something like that. That's largely what inflation is. So it's not like Detroit's not going to grow. It's just, are you going to get 3.5% or are you going to get maybe 5%? And that difference between 3.5 and 5 means a ton for your money.
$300,000.
Hundreds of thousands of dollars for your money for just one asset.
Yeah, that makes a lot of sense. I would also say, just to kind of like put like a period on this growth conversation, is what's driving that growth, right? Like, what are the things that you fundamentally believe is driving that growth? Which is kind of like, I guess if our friend Nate is saying, I see it over the next 5, maybe not the next 10,
Mm-hmm.
I would assume that he's seeing growth drivers that may be temporary,
Mm-hmm.
right? Like, I think that there is real arbitrage happening in Detroit right now because the cost of these like historic homes have been so depressed for so long
Mm-hmm.
that there's like real cost arbitrage, right?
Mm-hmm.
That's really happening there. What's driving growth in Jacksonville is pretty sustainable things, right? We have this like very well balanced economy that is logistics, healthcare, finance, fintech, and government, right? Those are kind of like the big spenders here.
Mm-hmm.
We have things that are, these like tailwinds, that is what you just mentioned, this like warm weather climate, low income tax, business friendly, that's made it the number one corporate relocation destination in the United States, right? So like the job market here is really, really booming. Highest, fastest rising income in the state of Florida, which is one of the fastest growing states, of course. And like it has these like really sustainable tailwinds that are being supported by other things that are shown to drive sustainability. A campus from one of like the top public institutions in the country, University of Florida, Go Gators, is setting up a graduate campus in downtown that is powered by the biggest AI supercomputer, like public AI supercomputer to drive AI first jobs in healthcare and finance is like coming, right? So like the whole flywheel of everything happening is very, very sustainable in Jacksonville, which makes us believe that this is just part of like one big macro trend that's going to continue here. And oh, by the way, in the state of Florida, with the fastest rising median income and the number one job market and all these like jobs coming here, still underpriced for the
Right.
state of Florida.
Yeah.
Still the only city in the state of Florida that has a lower than the average than the median price home,
Right.
right?
Yeah.
So, that's kind of like a sustainable growth story that we're
Yep.
thinking about.
Cost of living here remains low.
Yeah, cost of living also remains super, super low. All right. So that's the pin on growth. We spend a lot of time on that because it is the number one driver of returns. Now we have a question in the Q&A from Gurley Adrian that I think is playing into kind of like one of the aha moments that you had with these folks. And Gurley's asking, do you think that the 32209, 32206, 32208 areas of Jacksonville compared to the Detroit $1 home? So I think let's zoom out first and talk about what these zip codes represent, GC,
Yeah.
and then go into like what I know that you really, really want to talk about.
Yeah, it's a great question. Great kind of lead into the next point. One of the things that a lot of turnkey providers do is they know what's important to a newer investor. And a newer investor, if they understand how you can really make money and profit in rental properties, and they know that they're going to be in a different part of the country, they just want to feel like the home is in a decent neighborhood. They just want to feel like it's in a good spot, right? And so what many providers will do is they'll label the rankings of the neighborhoods. And, there's an A ranking, a B ranking, a C, and a D. And A is generally the nicest neighborhood. D is, you don't want to go there.
Yeah.
Well, if an investor is not going to step foot in an area and they want to feel good about it, are you going to put a C or a D on that property pro forma there, Pops?
Probably is going to make me feel weird about it.
Probably is going to raise some questions, add friction, right? So much more likely, if it's borderline C or B, they're definitely going to put B on that pro forma. And, and it's unfortunate for two reasons. One, because the whole ABCD thing is completely subjective. What might be a B to you might be a C or a D, or what might be a C to me might be an A to you. It really is completely. Yeah. So I mean, it could be just it really doesn't serve a purpose, and and then what I have found it does is sets unrealistic expectations. Sometimes folks, are just fully not prepared of what it's like to own a rental property. So if they in their head think it's an A neighborhood and then there's some vandalism in the property, they're just not prepared for it. So long way of kind of introducing the concept that, you got to really have a very firm grasp on what neighborhood you're investing in where. And it's not easy to do. A lot of this is you're going to lean on your turnkey provider in that area if you're not local. And you're going to have to trust their perspective. There are some ways that I can kind of help you understand, is this more likely to be, a lower ranked neighborhood, or is it more likely to be a higher ranked neighborhood? But what I would encourage you to do is to do your due diligence. And more than that, I would encourage you to get really excited about actually being in what many people would call a C neighborhood or a workforce housing neighborhood. Because a workforce housing neighborhood is the place that we invest in Jacksonville. It's the place that I own. All 400 and something of my rental properties are in workforce housing neighborhoods. These are neighborhoods that you want to own homes in because, number one, it's producing the best risk-adjusted return for you as an investor. It's also helping out your community because this is an area where housing is needed the most. And when you invest in housing in this area, you're actually helping out affordability in an area that is most needed. So, you know what? I should probably answer Gurley's question before I go down this path because I feel like I use that segue to kind of get to this next point. Here's the deal. 32209, 32208, and 32206 are neighborhoods in Jacksonville. Those are some of our core neighborhoods. Those are workforce housing neighborhoods in Jacksonville. Very hard for me to say whether a Detroit neighborhood is exactly that same way. They could be a little bit nicer. They could be less nice. Most often what I see is that if you're looking at another market and looking at a pro forma for another market, you're probably going to see a really nice letter on there. I just wouldn't trust it. I would do your own due diligence. If you see an A or if you see a B or if somebody says this is the nicest neighborhood, trust but verify and do a whole lot of verifying there. What you will most often find is that it is workforce housing. They just didn't want to call it that because it's a harder thing to get people excited about. But what I try to do and what I hope to do with all of you is to help you get excited about owning workforce housing because it's a beautiful asset class to invest in. There are a lot of pros. There are some cons, but the pros far outweigh the cons. And then if we know exactly what we're investing in, we go in with both eyes open. It's not perfect. It's not rainbows, but it just works. So there you go.
Before we go into that, wasn't 32209 like the number one neighborhood for home price appreciation in the country recently?
Yeah, it was.
Like isn't there like a more straightforward answer there if you're a little bit less humble, GC?
Yeah, absolutely. Well, workforce housing neighborhoods in the state of Florida, the last time we had a report done was 2021 on a neighborhood basis.
Yeah.
32209, 32206, and 32208 were some of the fastest growing neighborhoods in the entire state of Florida. And 32209 has the neighborhood that was the absolute fastest in all of the state of Florida. So yes, workforce housing, C neighborhoods actually perform the best on a local level, state level, and on a national level.
And I was showing this a little bit earlier, right? But we have this chart here that shows that workforce housing has led the US in home price growth since 2002, right? So this idea of workforce housing has like some real first principles thinking behind it in the sense of in growing cities, people that show up and develop new construction love to develop new construction for like upper income, middle to upper income, like the demographic classes because there's more margin in that. So the workforce housing gets underdeveloped in growing cities. And if you know basic economics, first principles, right? Supply starts to like get really constrained as demand continues to grow up in these like growing cities, right? So no surprise that in general, workforce housing has led the U.S. in home price growth since 2002. The other thing that I like to talk about, I think that you've kind of turned me on to, GC, is the idea that when it comes to workforce housing, it's got this like beautiful risk mitigation thing that I really right? Like I like the idea of if I'm going to be owning a rental property, I'm going to be owning it for 30 years. I want to be able to like withstand the highs and lows of markets and recessions and all these different kinds of things. And when you own like one of the nicer houses in a workforce housing neighborhood, then during good times, everybody that lives in that neighborhood wants to move into that house. During bad times, people that had like taken their disposable income and moved into a luxury apartment come back into that neighborhood and move into that house, right? So it has this like really, really nice risk mitigation piece. So all of this to say that we love workforce housing neighborhoods, and the idea that, JWB is all in on workforce housing neighborhoods in Jacksonville. You want to talk about this chart here, GC?
Yeah, so we looked at it from the national perspective, and we showed that workforce housing has led the US in home price appreciation over the last 20-something years. Well, now this is a micro look. This is looking at just Jacksonville, and we're looking at JWB's workforce housing neighborhoods. And what we've been able to show is that our neighborhoods have appreciated 42% more than overall Jacksonville since 2016. So those same rules and reasons why it works on a national level. We are undersupplied, have been undersupplied for a long period of time. Generally, there's not as much of an incentive to build in workforce housing, so it's not typically done, which reinforces the supply problem, which when there's a supply problem, you want to own it, right? And so that is one of the reasons why we love being in workforce housing neighborhoods. And that's the reason, ultimately, why our clients have earned so much of a return. I mean, our clients have over $480 million in equity, $480 million in equity by following this model with the right team, investing in workforce housing neighborhoods. And we don't have to sugarcoat it, right? We're not in the A's. We're generally not in the B's. We're not in the D's. We love being in the C's, right? We love being in workforce housing because it works.
Nicole Pimentel is asking me asking us to elaborate on the risk mitigation aspect in workforce housing neighborhoods. When I talk about this with GC, and I talked about it, at the beginning of the show, he's like, the risk mitigation piece is not something that, like we really have to like lean in today's show. It's more, for me, it's, I like my investment philosophy is I'm putting the majority of my kind of like long-term pie into rental properties, right? Into real estate, right? So like I'm trying to get like the highest floor I can for the highest risk-adjusted return instead of doing it another thing, so I can be risky with like a smaller piece of the pie. And for me personally, that idea of, workforce housing, a nice house in a workforce housing area being the thing that during good times everybody aspires to, and during bad times people come down to from a like, I don't know, echelon of like purchasing power, is something that I really like. I think if I were to ask you though, the risk mitigation truly comes from the lack of supply and the dirt and the excessive demand. Is that
Well, I actually wouldn't have gone there first. I just
Okay.
would have said positive cash flow,
Okay?
right? You just can't get positive cash flow and be in a growth market in many cities. It's just, that's why, you don't see cities out there that, are on a coast in the state of Florida
Yeah.
that have positive cash flow, right? You tend generally see cities like Detroit or Memphis or Indianapolis, like places where population does not grow as much. So why do I love workforce housing in Jacksonville? Well, if you go to the nicer neighborhoods, if you go to the B's and the A's in Jacksonville, you're not going to have positive cash flow. The purchase prices of those homes are so high that the mortgage payments and all of your other expenses are going to be higher than the rental income you get. So the number one risk mitigator, and why I love investing in workforce housing, specifically in Jacksonville, is because it produces positive cash flow. You also get the benefits of being in a growth market, which you don't get even if you get positive cash flow in other cities like Detroit or Indianapolis.
Okay, interesting. That being said, GC, if we're not going to focus on like A, B, C, or D, can you explain to us how you think about whether you are in a workforce housing neighborhood or not?
Yeah, we get this question from time to time, and I thought this would be a good thing to kind of leave everybody with today. How do you know if you're in a workforce housing neighborhood if you can't really trust the pro forma or the letter that people put on there? Well, here's what I would do. And it's not foolproof, but it's something that you can use. It's free and accessible, and this is something that you can use as a kind of just way to fact check. Think about your median home sales price in your market. And if you're at the median home sales price, then anything above that is called the nicer neighborhoods. Anything that's below that would be potentially workforce housing or low income. And think of it in terms of quadrants, right? You don't want to be above because you're not going to get positive cash flow. You don't want to be above median income.
Mm-hmm.
You want to be in that quadrant just below median income,
Mm-hmm.
but you don't want to be in low income. So let's call it the workforce housing quadrant.
Mm-hmm.
All right. So if you're at 50% is your median home sales price in your market,
Mm-hmm.
then take 50% of that, right? That would be the kind of the dividing line between those quadrants.
Okay.
Still following me here?
Yep.
I was trying to think of a way to easily describe this before the show, and I didn't really come up with this. This is the best I got.
We're just gonna talk to this.
All right. So again, starting at the median, go 50% of that. That's like the dividing line between your lower two quadrants. You want to be above that. You want to be above that dividing line.
Okay.
So call it between 50 to 100% of the median sales price of the market. That's the best thing I got to describe it.
Could you? All right. So if you're at the median sales price, yeah, you want to be somewhere close to 75% of that price point,
Yeah, there you go.
right?
There you go.
You want to be around 75% of that price point.
Yep.
5% more, 5% less, somewhere around there.
There you go. Yeah, I'd go even a little bit more than 5 or 10%, right? Like I would say anywhere really between 50 to 100% of the median home sales price is probably where you want to be. You're probably in workforce housing if you're there. If you are lower than 50% of the median, then you're probably in low income.
Got it.
If you are above median sales price, then chances are that you're going to be, in a nicer neighborhood, which can work. But the question is, are you going to get positive cash flow? Don't throw away positive cash flow just to go to a nicer neighborhood.
Got it. So then this is the chart that you put together. You had a sample Jacksonville neighborhood. I'm assuming that all these, this wasn't one of the numbers that Gurley put up here, but like I assume that this is in line with the other neighborhoods that we just talked about, and then a couple of other Detroit neighborhoods that people have been like considering and bringing to you. And you did that analysis, and two of them don't qualify in this workforce housing piece. They're below that, within 50% of that median. One of them does, right? So this is kind of like, this is the questions that you would ask and the back of the hand math that you would do.
Yeah, exactly. And all this information is free. So if you wanted to go and find your market median home sales price for your area, you can just go to Zillow. That's where I went here. And then you can, look up the zip code as well for that area. Zillow allows you to do that. And then it's just math at that point. So yeah, this is not a perfect, but a free, easy way to say, hey, you know what? This property is like way below the median. Is it probably a low income neighborhood where I'm probably going to have higher maintenance costs and vacancy costs? Or is it just tucked right under median income? Yeah. That's probably the place that you want to be, because that's where you have a great combination of low prices, high rents, high rental demand, and you probably have a property manager who wants to manage properties in that neighborhood. Very hard to find a property manager who is willing and can do a good job managing properties in the low income neighborhoods.
Which brings us to kind of like the universal advice, right? Like this idea that most rental property investors have the order of operations wrong when they're executing a buy and hold strategy. They focus so much on the property and the market, right? Like they're just like, normally the market is somebody told them about it, or it's the one in their backyard, or like they just have access to a property. They spend all this time thinking about the property, and then do a quick Google search or a Craigslist search, or ask a couple friends who's a property manager that you'd go with, and essentially purchase an asset one time and marry someone that they just like did about 10 minutes of research on for the next like 15 to 20 years if all goes well. We believe that the way that you buy rental properties is, first, figure out who your team is going to be. Figure out who is going to be managing that asset for the next 10, 20, 30 years till you meet that goal of yours. They can describe to you what your goal is going to be and how your property plan is going to get there. Give you statistics based on past performance of like how they have brought other people to these goals, how their assets perform through learned knowledge, not through a book that they did or a ChatGPT statistic. And once you have that piece and you feel comfortable with that, wherever you are, wherever you're looking, and then you move forward with, okay, does this market fit my criteria? And then after that, the property piece is going to be really, really easy, right? So the number one thing I would say is, we just kind of like danced around this, but a lot of the folks that are out there offering these turnkey deals in Detroit, in many, many markets, including in Jacksonville, right? They're basically just like finding a property, giving you some numbers, and then pairing you with a property manager. Having the deep discussion, not just through the person that is selling it to you, but the person that is going to manage the property with you around those things is the number one thing that you should really focus on. And if that doesn't feel particularly good, then maybe if you can't find that person in that market, maybe that's not the market for you, because at the end of the day, you're kind of rolling the dice with somebody.
Well said.
Okay.
Nailed it.
Yeah, for real.
Yeah.
Okay, super.
I'm just tagging along.
I thought you nailed it today too, GC. I think that this is probably, you're showing up to this call. This is not the average market comparison that you're going to get. I'm sure that most people that do this kind of thing are going to put up two performas and like go property to property, right? Like we're talking about these like foundational concepts, because at the end of the day, rental property investing is not a transactional thing. It's a relationship thing. It's a relationship you're going to have with this house. It's a relationship you're going to have with that property manager over a long time. And you need to be thinking about these bigger picture things before you make these like short-term mistakes. So super pumped that we did this, GC. I appreciate you putting this stuff together.
Of course.
Yeah, we had pretty good attendance. We had like 70 plus folks here today, which is awesome. We never take for granted the idea that you come for an hour of the middle of your day on a weekday to get educated on this, ask great questions, bring great perspective, and allow us to continue to do this. So really want to thank the community. And you did pretty good comeback from vacation today. Did you see that?
Thanks, man. It's been it's been a great re-entry and ready to rock and roll.
Yeah.
We got a good show next week too.
Yeah. You want to talk about it?
I mean, we get to have the patron Santorios on the show, and I know Pablo and the patron Santorios have prepared in advance. They have some very good questions. Patron Santorios is one of our most successful investors and has owned, I don't
For those
remember.
of us that are new here, Michael Santorios.
Michael Santorios.
We call him the patron Santorios.
There we go. There we go. The patron. It just flows, right? I mean,
what about this name?
It was really good. One of our most successful investors, I don't know the number of properties off the top of my head, but probably 15 properties or so. And so he's going to bring a lot of his questions on how can I maximize my returns within my own portfolio. Pablo has, 3 properties with us, 5 total doors. And, and so there's a lot of collective wealth of questions and experience that I know you guys are going to pepper me with. And so I'm excited about it. It's going to be a great show next Tuesday.
Getting great responses here in the chat. Scott Saunders, who said he was coming in here excited for this one. He said great insights, right? So we passed his test of expectations, a whole bunch of other great things. Pedro Santor's in the chat saying, looking forward to it. I can tell you, I got into like a very good conversation with Michael at the Not Your Average Investor Summit. He's looking at this thing. He's so successful. He's looking at this thing, one step beyond the standard deviation of the average, not your average investor, to be perfectly honest. And I think it's a really great question to ask. He's looking at portfolio optimization. He's asking some things that, early investors might be thinking about and may not be right for them, but it might be right for Michael, right? So like, I'm really looking forward to the tension of the usual advice versus the expert, versus the place that he's at. And, I can tell you all right now, Michael and Gregg are not seeing from there's going to be slight disagreement on this strategy. I know this for a fact. So I'm very much looking forward to this tension. I know it makes him really uncomfortable that I just said this. Look at his face. And and I'm really looking forward to push this conversation into like, hey, what is the right strategy here that isn't just the typical strategy that we say. So Michael, super pumped that you're doing this. I'm super pumped to be there. And from now till then, little piece of advice for everybody.
Don't be average.